This is a video on a work in progress report. And we're going to take a look at a couple of things. The first one is going to be what a work in progress report truly is. Like what is it? And the second one we're going to take a look at is how do you actually create one? What are the type of data points that you need to create a work in progress report? The third piece we're going to take a look at is how do you actually read it? Because a work in progress report is a wealth of information about how your jobs are doing. And not just about how they're doing right now, but also what is going to happen in the future for your business. So how do you use the information in the work in progress report to do the forecasting, the future looking, forward looking work in your financial statements? How do you do that forecasting? So that's a work in progress report can really help you with that too. And the fourth piece is going to be on what happens when you're not using work in progress reporting in your financial statements. If your bookkeeper and your accountant are not using that work in progress adjustment on your profit and loss statement, how your profit and loss statement is actually going to look like. And spoiler alert, it's going to look like it just does not make any sense, because how are you having a gross loss instead of a gross profit? How can you have a gross loss when the job is apparently supposed to be making you money? It just doesn't make sense. So we're going to take a look at that. Why does that happen? And most importantly, how do you truly fix it? All right, let's go. So let's just jump in and take a look at an example of a work in progress report. So you can, if you're not using a work in progress report, or maybe if you are using it, but you're not sure how to actually read this, I'm going to walk you through so that you understand these pieces of the information that it's giving you and how it actually helps you make decisions about how the business is doing. So first, let's take a step back and look at the actual structure of this report. And I have used different colorings for this to make it a little bit clearer of what are the different sections. So the best way to think about this is that there's going to be 3 sections in the work in progress report. The first one is going to be about the contract data. The second one is going to be about all of the accounting data that you have on that particular job. And the third section is where the magic happens of the work in progress calculations. And I also want to give you a disclaimer here that work in progress report is going to be very, very difficult if your systems are not set up for this. And what do I mean by this? I mean that if this contract information right here that I have on from column B to E, if this is going to be in a lot of different spreadsheets or you have them like written somewhere, it's going to be really, really hard to gather all this information in a timely and a very consistent basis. So it's important that whatever you're using, are you using a type of software, maybe you're using Buildertrend, maybe you're using CocoStruct, maybe you're using something else, that you have a central repository of all your contract information, all your estimates, all your change orders, and anything that you need to get the contract income and the contract cost that you have actually sold this job for. Because if you don't have that, it's going to be very, very hard to put this information together and in a timely manner whenever you want to do it. So ideally, you want to make it so that it's easily accessible and you can access it at any point in time, like even right now, just click a button and you can get that. That is the ideal version if you could do that. So because that is going to give you the most up-to-date information that you have on your particular jobs and on your particular contract. So that's a side note right there. So the first part of the work in progress report is going to be gathering all this contract data, all the estimates and change orders. Some people like to actually have change orders as separate jobs. I generally don't advise that because it's going to give you, especially if you have a lot of change orders, it's going to give you a whole list of these jobs. They're not really jobs. They're mini change orders that go into particular jobs. So to make this easier on yourself and to make this cleaner, what I like to see is I like to actually roll all those change orders into that particular job. So I think of it as original contract for a job that you had. That is like the master contract, and all these mini contracts, the change orders roll under that one. And that would be, even if you have, let's say, 5 change orders, you would still see one number, one actual contract, and all of these change orders that would be included into this number, because that is going to make a lot easier to put up the work in progress report, and the reporting is going to be easier as well. But again, it's up to you how you want to do it and how you're actually set up to do that. So what you want to do is you want to get information of the actual contract price or the contract income that you're going to be getting, the cost for that particular contract, and all, again, the gross profit that you're going to have with that, and also the gross profit margin. So the second piece of the work in progress report is going to be your accounting data, meaning how much have you actually billed to date for that particular job, and how much cost has come through for that particular job. Also, as a side note here, the bill to date doesn't mean that you have received cash for that particular job already too, because it just means that you have sent out the invoice, but maybe the customer hasn't paid you yet. So this is not looking at cash. It's really looking at how much have you actually billed yet, because you could have billed, but they haven't paid you yet. So just keep that in mind as you're looking at this. You can also have another, column here if you wanted to figure out how much cash have you actually received already from that particular job as well. So one of the ways to look at that would be if there is anything for this job on your accounts receivable report from your balance sheet, that will tell you that you have billed the customer, but they haven't paid you yet. So for example, if I have billed them $126,000 and the last invoice was for $26,000, and they haven't paid me yet, I would see that on my accounts receivable report, meaning that the cash still needs to happen, hopefully sometime soon. The same thing from the cost to date. Just because I have this as $9,500 doesn't mean that the cash has actually gone out the door as well, because I could have received an invoice, but I haven't paid it yet. And the information for this, you would see it on your accounts payable report. So anything that's on your accounts payable means that the invoice has come through, but you have not sent out the cash yet. But for this particular scenario, for the work in progress report, we're not concerned about the cash. We're concerned about how much have we actually billed and how much cost has come through for this particular job. So just so you know. And the third part of the work in progress report is where all the magic calculations happen, where you get all this information on how the job is actually doing, because this is good data, but it doesn't really tell you like how the job is truly doing, right? So you will need two things. How much have you actually billed so far? And how much cost has come through yet in a percentage, which also means percentage of completion. So what this really means is how much cost has come through relative to what is the total contract cost. And in this particular scenario, in job A, it would be $9,500 divided by 261. That will give you 4%, meaning that 4% of cost has come through for that particular job. And that also means that 4% of the contract has been completed. So for the contract completed, we are anchoring that to cost. When we get to 100% of the cost, to that $261,000, we have completed 100% of the actual contract. Keep in mind that sometimes the contract can actually go above the 100%, especially if you're running really hot in the cost section. So meaning that you're going over budget. So that can happen as well. And then you have a couple of other calculations that you will see. How much total contract is left to bill, meaning total contract minus the bill to date is total contract left to bill. How much total cost is still left, because we want to know how much total cost is still left, meaning total cost of the contract minus cost to date. And then this particular section right here is income earned to date. How much income have you actually earned to date, and how much income is there still to earn? This is very important when your accountant is going to make a work in progress adjustment to your financial statements if you're using that type of accounting. And I would very much advise you that you're using that type of accounting, because in the later part of the video, I'm going to show you what happens if you're not using work in progress adjustments on your financial statements, how they're going to look a lot funky. And this is the section that it's going to tell you whether you have over or under billed the particular contract. Now let's take a look at what does over and under billing means and why you should care about it. Over and under billing essentially means is whether you are using your own money to fund that particular contract or you're using your customer's money. And let's just jump into the example right here. For the job A, you will see that I have billed 26% of that particular job already. So we have $493,000 that we need to get. We have already billed 126. That is 26% of the 493. However, you will also see that out of $261,000 in costs that we expected for this particular job, we've only so far received $9,500. So the cost is, we've only gotten 4% of the cost for this job, which also means that our percentage of completion, how much we have actually completed this job, is at 4% as well. So whenever the percentage of how much you have billed is more than the contract completion, that means that you have overbilled. So when you're overbilling, meaning that you're getting a lot more money up front than what the cost has come through yet. So when you're overbilling, you're getting more money up front than what the cost has come through yet. So the cost is going to come in the future, but you have gotten more money up front. And in terms of the cash flow management, this is really an ideal situation because you are not using your own money to fund the cost for this particular job. So you're using your customer's money to fund for this job, right? You can also have a situation, which generally doesn't happen. Since this is an example, but I still wanted to give you this. For example, job D, we have billed 49% so far, and we have also gotten 49% of the cost so far. I've been doing this for years, and I've always never seen the percentages to be the same. But that could happen. So that is the job has not. So in this particular scenario, the job has not been overbilled or underbilled. It's exactly where the two matched up. Usually, you will be either in the overbill or underbill. The underbill is job C, where we have billed for 56%, but the cost has come through at 76% of the cost already. So we have actually underbilled. What this means is that we are using our own funds to actually cover the cost of this particular job. So this is a situation that you want to avoid as much as possible. If you have to be on the side of over and underbilling, you always want to be on the side of overbilling, so that you're not using your own funds when it comes to the cost of these jobs. Also, a note of the overbilling and underbilling the jobs. Again, when you are overbilling the jobs, meaning that the percentage of billed is more than the cost of completion. And when you're underbilling is exactly the opposite, when the contract percentage completion is more than what you have actually billed. And that is a situation that you want to avoid. And if you're interested in how you know whether you have underbilled, overbilled, again, you can look at your work in progress report. It's going to tell you there should always be whether your job has been under or overbilled. And if your accountant or bookkeeper is using the work in progress report to make adjustment to your financial statements, you will also see that on your balance sheet as well. So if you are overbilling, again, the percentage of billed is more than the contract of completion, that is going to be a liability to you, because you essentially, what this means that is you have taken money in without actually completing the work already. So that is a liability, and your customer, if you don't deliver that particular, contract, is entitled to get that money, and that's a whole legal section. But in the accounting terms, that one means that you are liable to complete that work. You have taken the money, but you are liable to complete that work, right? So it's a liability. In the underbillings, where your contract completion, where you got more cost than you have actually billed in the percentages, that is becoming your asset, because you have used your own money. You have used your own money to cover the cost. So you need to get reimbursed for that. That is going to be your seen on your assets on the balance sheet statement. So if you're trying to take a look at how much have I overbilled or underbilled, you can go and take a look at your balance sheet if your accountant is using work in progress to make adjustment on your financial statements. So that's how you will see it. If you're overbilling, it's going to be a liability. If you're underbilling, you will see it in the asset section. So now that we've gone through all these sections in a work in progress report, I want to give you a particularly useful tool that you can use when you're looking at your work in progress report and you're trying to make decisions about your business and where are we going to be in the future. Because this is a very, very good indicator of how your business is also going to be doing in the future versus how it's doing right now. So each one of these sections also means something. So for example, the total contract left to bill, which is again, what is the total contract price minus how much have you actually billed to date, is the total contract left to bill, how much you still need to be billing it for. That is going to be very, very useful to you if you're trying to project the future of the business, because that is going to tell you how much cash is still coming in the business. So you know exactly how much you're still going to get in the future months. Ideally, if you can combine this, for example, if you have a specific job and you know that you're going to have to hit certain milestones, invoices, that you have those invoices actually created in the system already. You don't send them to QuickBooks yet until they're actually due. But if you have them created in, for example, you have a CoConstruct or Buildertrend or whatever it is, because then you know that, in October, I'm going to get $50,000, and in November, I'm going to have another 50, in December, I'm going to get another. So you can have a payment schedule built in, and that is going to tell you exactly when you're supposed to get those payments in. And that is going to make significant difference in how you are able to project your cash flow in the next, especially if you have long contracts, in the next year, even if you have that is super, super useful when you're looking at that. So that is good for the future cash in. Also, the total cost left is going to tell you how much do you still have to pay out, right? And especially if you're using that with the purchase orders. So for example, if I know that the invoices, for example, in this job A, so far I have only received $9,500, right? But I know that I still have 251 that it's left. So I know that eventually in the future, I need to pay these invoices that are going to come in. That's 251. And I'm trying to figure out when that is going to happen. A lot of that is going to help me if I have purchase orders set up. If, for example, if I have the material that I ordered and I'm already contractually obligated to make these payments in the future, I could say that, okay, out of the $251,000 that I have left, I have already ordered $100,000 of that, and I know that that is going to probably be invoiced in the next maybe a month or two. So then I know exactly when the cash is going to happen, when I'm going to pay it out, and that is going to help me with the cash flow predictions for the future. So again, the total contract left to bill is going to give you the information of how much cash in the future is going to come into the business, and the total cost left is going to tell you how much cash is going to go out of the business. So cash in and cash out, very important if you're doing cash forecasting. Again, and you can get all of that by doing the work in progress report. So the work in progress report is a very, very useful tool when you are using it for your finances. And the last but not least is the income still left to earn. And that is how much of the revenue is still going to be reflected on your profit and loss statement. Because, and I'm going to show that to you in the next couple of minutes, is that if you're using a work in progress report, your revenue is not going to be equal your cash. And the reason for that is because if you're using cash accounting in construction and remodeling businesses, your profit and loss statement is going to look like a roller coaster. And I'm going to show you why. So when you're adjusting for that revenue, this is the column that is going to help you how much future revenue is still coming in. And the over under build is going to help you to adjust it for that particular moment in time, for that particular month when you're doing these adjustments. And this is especially important for your accountant. So now let's take a look at a profit and loss statement, especially on the gross profit section of a business that is not doing a work in progress adjustments in their financial statements. What you're going to notice here, I only have one job because as you will see, if you put more than one jobs in there, it's going to become a mess. And I want to walk you through what is truly happening here. So let's first just take a look at this graph. You will see that the gross profit is up and down and up and down. And then, in right here in January, we're making $28,000 in gross profit. And then we're actually making $5,200 in loss in the next month. And then in May, so in April, we're not doing anything, but in May, we're losing money. And then in January, the next year, we're actually losing a lot of money. We're losing $23,000. And when you look at this, if you ask yourself just a simple question, how is my job really doing? Am I making money or am I losing money? How is it doing? Are you able to figure this out by just looking at this? Probably not. I mean, I put this together and I could not tell you whether I'm losing or making money off of this because it's very, very, very hard to make any heads or tails off of this because it's all over the place. It's really hard. And the reason why this is so hard is because here is a perfect example. So January, we have actually billed for this job. And this is just one job. Just keep in mind, this is just one job. We're just looking at one particular job. Job A, that's it. And that is the job that we said that we're going to get $493,000. The cost is going to be $261,000. The contract, the gross profit that we're supposed to get is $231,000. And the margin, the gross profit margin is supposed to be 47%. So these are supposed to be really good numbers. I mean, this is a pretty healthy gross margin. Is this reflected in this graph at all? Probably not. I mean, it's very hard to see. If you look at this job, you really have no idea how this job is really doing, especially when it's going over fiscal years, meaning that your job is starting in year one, but it's actually going to go over to the next year, the next fiscal year. That makes it really hard to see. So in January, we have billed for $49,000 and we have gotten some cost in. So, our gross margin right now is at 58%, which also tells you my whole job is at 47%. So why is my gross margin here at 58%? So that's a little bit of a red flag right there. And then in February, we have not billed anything, but we have also had the cost come through. So we actually have a loss. And obviously, we can't divide by zero. So there's no margin right there. And then in March, we have had a lot of billings, but not that much cost in. So the margin right now is 62%. And then again in May, we have a loss again. So this is very, very hard to see what is going on. And keep in mind, this is just one job. One job. If you have 20 jobs, if you have 30 jobs, maybe you even have 100 jobs, this is going to be very muddled, and it's going to be very, very hard to figure out how the job is truly doing, which is why the work in progress comes in to help. So here is the same job with a work in progress adjustment. This is something that your accountant would do to adjust for this. And you already see this, that even though the gross profit is going up and down, and the reason for that is because we only have one job here. So obviously, if we had more jobs, we would have activity in particular months when it looks like there's no activity. So this is just one job. The reason why this looks up and down is because it's just one job. But you will already notice here that our gross profit never goes into the negative, because the job is making money. If we are saying that the job is actually, here's the job right here. If the job overall needs to make a gross profit, and let's say that our costs are going to be exactly on the line where our costs are estimated, we should make profit, gross profit, as the cost and the billings come through. So it makes no sense, if the gross profit margin on a particular job is at 47%, that we would have negative months, or maybe even gross margin at 65% or even at 100%. It does not make sense. So that's what the work in progress adjustment stabilizes this. You will never see a gross profit going to the negative. Truly, if you truly have a gross profit going into the negative, you have a tremendous problem on your hand with your business. You're probably going completely out of business, because when your gross profit is going into the negative, that means there's no money left to take care of all of your other expenses in the business, all your utilities, your salaries, your your marketing, your accountant, whoever you might have in the operating expenses, because you're already making a loss in the gross profit. So in this particular scenario right here, when we see no WIP, this just does not make any sense. And that's why a lot of people are so confused when you're looking at their profit and loss statements, is because they're not doing this adjustment. It just doesn't make sense. It really doesn't. So that's what the work in progress adjustment is adjusting for, to truly reflect what the margin really needs to be. Obviously, if the cost is going super, super high, the margin is going to be adjusted because the cost is going to be higher. And that's going to be when, you have reached at 100 plus percent of completion for that particular job. And when you are, and again, going back into the work in progress report, the percentage completion means how much cost has come through for that job. And if the percentage of completion is more than 100%, that means that the cost for that job is more than what you estimated. And now you're going to see reflected in your actual margin, because your margin is going to be lower now because your cost is going to be higher. But that is really going to happen when the job is starting to run hot, right? So until then, it's always going to be at the same percentage as the gross margin happened. So right now, what you see here, for example, in the job A right now, in January, we have billed $49,000, but our cost has come through at $20,000. So we have billed 10%, but our percentage of completion is only at 8%. So what does that mean? That means that we have overbilled meaning that what we have built is more than what our cost has come through. So you have actually only earned 39,000 of that, which means 8% out of 493,000. So the difference between 39,000 and the $49,000 is the overbilling, and we are going to correct that on our financial statements. We're going to take that overbilling and we're going to push that into the liability, that $9,800, because we're liable for that. We have not received that cost. We have not earned that money yet. It does not have the place on our profit and loss statement. We have not earned it yet. It needs to go into the balance sheet. It needs to go into a liability and stay there until we have actually earned it. We're going to move it back into our profit and loss statement after that. And that is going to give you that true margin for this job, which is 47%. And that's how you get this nice, smooth profit and loss statement. And you'll see in April, there was no revenue, there was no cost, and there was no billing that happened. So our gross profit is zero, because again, this is just one job. You probably have more jobs, so you'll have gross profit happening in these particular months that are zero. But this is just one job that had no activity in April, so that's why this is a zero. So now you can see how this is actually smoothing your financial statements and it truly giving you the accurate picture of what is really happening in the business and how your jobs are doing. Also, another thing that I want to point out here is that you will see that in year one, we have actually because again, this is just one job. We have made in profit of $136,000, which is, again, this is that 47% of margin. And again, in year two, we have also made 47% in margin, because this particular job has crossed over fiscal years. So it has crossed over fiscal years. But if we have not made this work in progress adjustment, if your accountant or your bookkeeper did not make that, let's take a look at how your year one and year two profitability is going to look like. So what you're going to see here, that if we did not make this work in progress adjustment, you'll see that year one, we have made our gross margin is at 50%, but in year two, it's at 41%. This also doesn't make sense. How is this possible when the gross margin on the job is at 47%? How did we make 50% in year one, and then in year two, we have made less money in 41% when the job is at 47? So you see, the reason why you want to use your work in progress adjustment in your financial statement is to truly get that accurate picture of what is happening with your finances, what is happening with the jobs. Because if you're not doing that, it's so hard to make decisions on your business. And it's so hard to figure out whether the jobs are making money, whether the jobs are not making money, what's really going on. So that's why the work in progress report, it is so important. And if you're not doing that, I encourage you to talk to your bookkeeper, you talk to your accountant, and start doing that. I hope this is helpful.